Hi everyone. Let's talk about consumer goods. Consumer goods can be categorized into durable goods, non-durable goods, and services. Durable goods have a shelf life of 3 years or more, whereas non-durable goods have a shelf life of less than 1 year. These are called fast-moving consumer goods or FMCG. Nearly everyone uses FMCG products on a daily basis. In India, FMCG is the fourth largest sector and steadily growing. By 2025, the Indian FMCG industry is expected to be valued at 220 billion US dollars. In our opinion, a potential investor should look at several sector specific checkpoints while determining which FMCG company to invest in. Now let's understand the business. FMCG sector has several different segments such as food and beverages, home and personal care, healthcare, etc. Every company may not operate in the same segments, which is why, while viewing revenue, it is vital to segregate it by segment. For example, Dabur operates in food and beverages, home and personal care, and healthcare, with these being the power brands in each category. Whereas Bajaj operates in hair oils, virgin cold pressed oils, premium personal care, and skincare, with these being the brands in each category. Now let's review segmental revenue breakdown of Dabur. As we can see, healthcare and home and personal care segments make up for 84% of its total revenue, followed by its food and retail business. Further, an investor needs to review EBIT margin as well. The consumer care business has had an EBIT margin of 24%, whereas the food business had an EBIT margin of 16%. The retail business is currently making a loss. There could be various reasons for that. The company could still be getting the retail business off the ground, or it could also be a one off. The cause of this should be investigated in the management discussion and analysis or the company conference calls. It is important to know if the company is dominating the market in any of its segments. Here we can see the different rankings of several Dabur products over its segments. How is the company growing? There are different growth strategies that can be used by an FMCG company. Let's begin with the premiumization trend. Why are FMCG companies looking to enter the premium markets? Markets for mass products have been saturated. In order to maintain market share and continue growth, companies are now making premium products to capture different customer segments. This leads to higher margins and therefore higher profitability. The chart on the left shows the difference in population demographics in 2017 versus 2022. There has been a clear increase in the income of the population. This is set to increase further over the coming years. On the right, we can see the kind of products that are wanted by the consumers. While the mass population is 56% in 2022, they only account for 39% of the sale of mass products, whereas popular and premium products account for 34 and 27% respectively. This shows a major shift in consumer preferences. Now let's take examples of the premiumization effect on company products. Dabur honey, which is sold for 62 rupees per 100 grams, has had majority market share for decades. However, Tata has now launched its premium honey, which costs rupees 120 per 100 grams. Tata Salt, which has been the market leader for salt since 1983, costs rupees 2.5 per 100 grams. But Tata has since launched its Salt Super Light, which is a low sodium salt launched in 2021 that costs rupees 6 per 100 grams. HUL's Taza tea, which is a market leader, costs rupees 20 per 100 grams. Tata has recently launched its 1868 premium tea, which ranges from rupees 350 to 2000. Here we can see how HUL had only 22% premium products in 2012, which has now grown to 33% in the past 10 years. Moving on, let's look at digital brands. Companies are launching digital-only brands. The products of these brands are only available in online platforms. Here we can see brands from different companies which have been launched digitally only. Why is that? As India is becoming more and more digital, companies are targeting consumers online with creative digital brands. We can notice a simple change in consumer mindset. A few decades ago, not many women were part of the workforce, which meant that they could physically go and buy products when they required. However, with passing time, more and more women are opting to work. They may not have the time to go and buy products and may prefer to order online. In such a situation, it is also preferred by the company to launch D2C brands as it increases their online presence and they can save on the cost of displaying in shops. Next, let's talk about product launches. FMCG businesses need to consistently innovate existing products and create new products to satisfy evolving needs of the consumer. For this, let's track the number of launches per year, evolution of the product over years, and brand extensions of an FMCG company. In 2022, these brands launched many different products, as we can see on the left. Dabur reported that these new launches led to a 5.6% increase in revenue. In February of 2022, Dabur launched Dabur Virgin Coconut Oil to strengthen its presence in the coconut oil market. Dabur also launched health food drink Dabur Vita and winter healthy Chyawanprash in 2021. In October of 2021, Dabur entered into the diaper market with Dabur Baby Super Pants. Here we can view how various Dabur products have evolved over the years. Taking two examples of Dabur products, we can see that Dabur has extended Real's brand over the years. Starting from juices, they made milk and fizzy drinks. Real also entered the health market by launching Real Seeds. Dabur Amla hair oil has extended to different oils for specific hair care concerns, a premium oil as well as oil for kids. In both these examples, we notice that these brands have extended to capture more market share and they have premiumized products at the same time. The next growth factor is penetration. Currently, 60% of India's population is rural. However, they contribute only 30% to the FMCG industry. Companies are now targeting more villages in order to expand their reach. Taking Dabur's example, from 41,000 villages in 2018 to over 89,000 villages in 2022, the company has increased its reach by over 119% in just 5 years. Let's look at the final growth factor, acquisitions. A business acquisition occurs when one company buys most or all of the shares in another company to assume control of its assets and operations. Why does a company acquire another company? Let's review this with examples. In order to enter a new market, Dabur acquired 51% stake in Badshah Masala. This marked Dabur's entry into the branded spices and seasoning market in India, which is valued at over rupees 25,000 crores. To enter an underpenetrated category, HUL acquired Oziva, a leading plant-based wellness brand which focuses on lifestyle protein, hair and beauty supplements, and women's health. To expand the presence in an existing segment, P&G acquired Merck. The acquisition will enable P&G to expand its consumer healthcare business by adding a portfolio of physician-supported brands complementing to its own brands such as Vicks, Metamucil, Pepto-Bismol, Crest, and Oral-B. Now Aditya will explain branding.
Now, the next important checklist to analyze an FMCG company is to understand its ability to build brands. Brand gives business longevity and pricing power. Now, how do we understand that actually a brand has been created by a company? Brands are created over a 10-20 year period. So we look at which brands company has launched in the past 10-20 years and is it in the top 5 position of that category today. We look at top 3 selling products of Dabur. That is Dabur Chyawanprash, established in 1949, Dabur Honey, established in 1990s, and Real Juice, established in 1996, all of which are at least more than 2 decades old and have a revenue over 1,000 crore and are category leaders in their market. The market share has been fairly stable over the years and have been able to gain incremental market in the recent past. Market shares can fluctuate in the short term due to heavy marketing and advertising by the competitor. But what is more important to look at is the longer term trend of these brands' market share and its position in that category. Another aspect to look at is how strong is the brand recall in the consumer's mind. That is, which brands are on top of their mind, as high mind share leads to higher sales. For example, which brand comes to your mind first when you go to buy honey or juice? That shows the level of mind share consumers have for that brand. Now that we have understood how to analyze the brand building ability of an FMCG company, we now look at one of the greatest advantages of building these brands, that is pricing power. So, what is this pricing power? Pricing power basically means that even if a competitor decreases prices of a product in that particular category, then the company doesn't need to drop prices and is still able to maintain its market share in that product, that its sale is not affected by any of these competitive exercises. Or an alternate view also look at pricing power is the company's ability to pass on the increasing raw material cost to its consumer without any major lag and thus not losing any volume of sales in that process. So how do we check whether a company really has pricing power or not? One can look at a gross margin trend over a very long period to get an idea if those margins are industry leading and raw material prices increase are being passed on to the consumer easily or not. In the case of Dabur, we can clearly see that gross margins are stable around 50% over a 5-year period, whereas the prices of crude palm oil, one of the key raw materials of that company, had huge volatile moves between 2008 to 2022, 2018 to 2022, which can be seen in the picture. But is it sufficient to look at the gross margins? One more metric which needs to be looked at is EBIT or EBITDA margins, because there can be instances where the company might be relying on heavy marketing expenses through advertising or by giving higher trade discount to its distributor just to maintain its gross margin and in turn distorting its operating profit margin. So operating profit margin should also be stable or increasing over a long-term period. Thus, we can conclude that to assess if the company has got pricing power or not, we need to look at the 3 metrics, that is gross margins, EBITDA margins, and market share, all of which should be stable or increasing over a longer period time. One more point I would like to add in analyzing the branding and pricing power of a company is to look at the distributor's margin. If the margin given to a distributor by the company is really low as compared to the industry, but it is still able to find its place on the shelves of the shops, then it means that product has got a great market pull and it stocks out of the shelves really fast. The next checklist we look at is the inventory turnover ratio. That is the number of times revenue generated of the average inventory maintained by the company. How do we really see if the products of an FMCG company is really fast selling or not? Now, this metric gets really important for the sector here because unlike most of the products, FMCG products have a really low shelf life and needs to be stocked out fast. Thus, companies with low inventory turnover run a great risk of inventory write-off, in turn affecting their profits. Higher inventory turnover also leads to higher ROC for both the company as well as the distributor. Thus, companies with high inventory turnover can offer lower margins to a distributor and still maintain distributor's ROI and in turn expand its own margins in the process, thus further boosting its ROC. In the case of Dabur, company has been able to maintain its inventory turnover around 6 to 7 and have maintained very healthy ROCs between 23 to 25% in a 5-year span of 2018 to 22. Now we look at another metric, that is cash conversion cycle of the business. Cash conversion cycle is basically the number of days taken by the company to recover its cash after one full operating cycle of a business, right from procuring raw materials and converting it into finished goods and finally selling it to the final customer. Formula for cash conversion cycle is debtor days plus inventory days plus advance to suppliers minus payable days and minus advance from customers. Now, if we look at this formula from a businessman's perspective, debtors, inventory, and advance to suppliers are where money gets stuck in the business, And payable days and advance from customers are areas where money is received and reduces its funding requirement. But due to branding and pricing power, debtor days can be reduced and advances from customers can be increased. And with higher inventory turnover, inventory days can also be managed. With these in control, the company can give consistent bulk orders to their suppliers and negotiate for better discounts as well. Thus, advances given to them can be removed and can have a higher negotiating power with the supplier as their products have rarely got pricing power, so payable days can be increased subsequently. A lower cash conversion cycle leads to lower requirement for external funding for working capital, thus reducing costs for the business and in turn increasing the ROCE of the business as well.
Let's take a look at another aspect of FMCG business. Have you ever seen or wondered that why a surf excel is available in 5 kg pack to 300 grams pack to 150 grams pack and also a packet in 500 grams? So this is basically because the company is trying to cater to different sets of customers by varying the sizes of packs. So basically, it has been observed that a monthly income earner would like to stock a product or a detergent for, let's say, a month, as opposed to a person who has a daily wage and he will try to keep a stock of couple of days to a week. And to cater to these different sets of customers, the pack sizes varies. And these different size of packs are nothing but the stock keeping units or SKUs of a product. You must have heard SKUs in Shark Tank, right? So this is basically those SKUs and these different prices, like the 1.5 kilo product might be available for, let's say, 200 rupees, whereas a 500 gram pouch will be available for 75 rupees. So these different prices are called accessible price points of a product. And it is important for a company to be present in different accessible price points, because if I'm a daily wage earner, I would like to have spent 75 rupees at a time on a detergent rather than spending, let's say, 200 rupees and blocking my income for that amount. So let us now try to understand how a FMCG business delivers product from manufacturing unit to consumers. Whenever we want to buy a product, we might order it online, or we go to a kirana store, or we go to super chains like Big Bazaar or DMart. So these are basically ways in which an FMCG business is delivering their product to the customer. So whenever we say kirana store, it is basically in technical terms general trade. Whenever we go to buy to DMart or a Big Bazaar, it is basically modern trade. And whenever we go to online and purchase products online, then it is basically called e-commerce. Now, these are basically different ways in which the company is delivering their product to us, which are the consumers. Now, when we are investing in a company, in a FMCG business, it is important to understand the presence in these three different formats. So let us try to understand how efficient is the FMCG business in these particular formats. So first is general trade. General trade is basically our local kirana stores. Now there's a whole lot of supply chain in between, where there's a manufacturer, then there is a distributor, then there's a wholesaler, there is a retailer, and then we go and buy the products from retailer. So now in this entire supply chain, there might be more players which are maybe stockists, sub-stockists, another word for a distributor or wholesaler, but this is the basic supply chain that goes on. And each player in this supply chain might earn a bit of a margin, let's say 2-3% in between, and pass on the product or sell the product to the next person in the supply chain. Now, to understand the efficiency of their distributor, of the distribution system, we need to see whether the company is able to increase the distributors over a period of time and whether the revenue from each distributor is increasing. So let's, for example, take Dabur. Dabur is basically, if you can see over here, the number of distributors for Dabur has increased from 3,400 in 2020 to 5,000 in 2022. However, the revenue per distributor has decreased from 2.5 crores to 2.04 crores. which means that even though the Dabur is increasing its efficiency by increasing the number of distributors, its revenue per distributor is not increasing, which might not be a great sign, but still the revenue as new ways of distribution like e-commerce and modern trade are arising, the revenue from this particular channel might get bifurcated to other channels as well. However, we need to compare it with other companies or over a longer period of time to see if the company is efficiently selling its is efficient in general trade of format. So coming to e-commerce, as e-commerce has been gaining prominence over the past decade, now it's important that the business has a presence in the e-commerce platform and their revenue is increasing in this particular distribution system as well. So when we look at Dabur, it has around 60 crores revenue in 2018 in e-commerce platform, which has now risen to 700 crores. In 2020, in 2018, it was approximately 5.8% of revenue, whereas now it is 6.5% of revenue. So as we can see, the share of e-commerce in the overall revenue has been steadily increased as the consumers are moving more towards the online platforms to make purchases. Similarly, the presence of FMCG business or FMCG products in different modern trade stores like Big Bazaar, T-Mart, and Grofers. It's important because as these stores are gaining prominence, consumers are preferring to buy products from these stores, and they are also providing heavy discounts. And because of which they are able to pass on these discounts to the consumer. So the presence of the business in these stores is also of equally importance. Now, it is important for us to understand how efficient the company is to manufacture the delivered product. To manufacture a product, the company will need plant and machineries. As the revenue increases, the company will need to increase its production capacity. And the additional capacity can come either by improving the efficiency of existing plants and equipments, basically getting more production out of existing plants and equipments, which is also called as debottlenecking, or the company can purchase an existing facility from probably another company, which is called as brownfield expansion, or the company can set up altogether a different plant at a new location from scratch, which is called as greenfield expansion. Now, to understand how efficient the company is using these fixed assets, we compare the amount of revenue these fixed assets are generating with the amount of fixed assets the company has. And this is called as the fixed asset turnover ratio, which is basically revenue upon fixed assets. The higher the ratio, higher is the efficiency of companies' fixed assets. Now, let us look at how Dabur fixed assets are performing. So if you look over here, Dabur's fixed asset turnover ratio has increased from 3.9 in 2018 to 4.8 in 2022, which shows that Dabur has increased the efficiency of its fixed assets to generate higher production, which is leading to higher revenues. As the company operates in different segments, for example, Dabur operates in consumer care business through its brand Chyawanprash, and also in food business through its brand Real Fruit Juice. So company incurs capex, which is capital expenditure, in these segments to increase production if they see future growth in these particular segments. Understanding the in which segment the company is incurring capex, which is basically increasing its plant and equipment, will help us to understand the direction of business. For example, if you look at Dabur, the company has been incurring the capital expenditure in its consumer care business and in its food business. That is, it is building, increasing its plants and machineries in these two segments. Now, if you look at the EBIT margin, that is the profitability in these segments, the EBIT margin turns out to be around uh, approximately 24% to 16%. 16% in food business and 24% in consumer care business. Also, these segments are the ones whose revenues have been increasing to the approx 6 to 7%, which is highest for the company. So this is how understanding the direction in which the capex is increasing will help us understand the direction in which the company sees its future growth. Now let us look at some different expenses that an FMCG business incurs to generate revenue. Some of the important costs that an FMCG business incurs are advertisement and marketing, R&D, and employee cost. Now let us look at one by one why they are important and how to measure its efficiency. So first one is the advertisement and marketing cost. In FMCG, salience is driven by advertisement. If the company is unable to create salient ad despite high advertisement cost, it raises concerns. The goal is to make impactful advertisement campaigns at a competitive cost, tracking marketing expense with respect to revenue to verify whether an increase in marketing expense is leading to corresponding increase in revenue is important. So to understand this, we will compare revenue with marketing expense by simply dividing them. So basically the ratio we are looking at is revenue upon marketing expense. It will basically tell us that how much of the revenue 1 rupee of marketing expense is generating and whether it is increasing over a period of time. If we look at Dabur, its revenue by marketing expense is 12.8 in 2018, which has increased to 14 in 2022, which basically implies that the 1 rupee spent on marketing has increased revenue over a period of time. However, to make it more reliable, we need to compare this cost over a longer period of time. Now, another expense that we are looking at is research and development. As the FMCG company launches at least 10 to 15 products every year, these products require the development of these products require the companies to incur research and development costs and to understand whether the company is efficiently using its R&D expense to increase to manufacture or to develop good products. It is we'll compare it again with revenue. The metric we are looking at is revenue by R&D expense, and we'll see if it is increasing. If 1 rupee invested or expended in R&D is increasing the revenue. So in 2018, the revenue by R&D expense was 241.8 for Dabur, which has increased to 261. Now, as we can see, every rupee spent on R&D has generated more revenue over a period of 5 years, which could imply that the company has been efficiently expending its R&D expense. Now, another important metric is the employee expense that the company is incurring. FMCG is an employee-heavy business. It requires a huge sales force to reach the remote areas and the rural areas of India, and that's why it is important whether to understand the efficiency or the amount spent on the employees and whether they are able to increase the generate additional revenue. So the metric we are looking at is revenue by employee benefits. And for Dabur, it has been 9.8 in 2018, which is now 10.1. So as we can see, it has more or less been stable, and the which implies that 1 rupee spent on employee benefits has generated 10 rupees of revenue, and on an average 10 rupees of revenue, and it has stayed consistent over a period of time. So the revenue growth can come from by just increase the number of employees. So these are some of the points that I wanted to discuss. Now Mansi will further explain you some points regarding business performance and the risk that a FMCG business might face. Thank you.
Let's take a look at risks. Product concentration risk. Taking Dabur as an example again, we can see that Dabur has 14 brands with a turnover of more than 1 billion rupees, with 3 brands having a turnover of over 10 billion rupees. Dabur has 9 power brands which account for 70% of its revenue. Dabur's healthcare segment includes 5 of the 9 power brands: Dabur Chyawanprash, Dabur Pudina Hara, Dabur Honey Tuss, Dabur Honey, and Dabur Lal Tel. The personal care segment includes Dabur Vatika, Dabur Amla Hair Oil, and Dabur Red Toothpaste, while the food and beverages segment has only Real. When a company is too reliant on a few key brands or products to drive revenue, it creates concentration risk. This means that there is an increased likelihood that a single point of failure can have a huge impact on sales, which can be harmful to the company's financial health. Lastly, let's review another risk to FMCG companies, which is the risk of private label brands. Taking only the example of instant coffee in India, Brew and Nescafe have dominated the coffee industry in India for almost 60 years. However, their market share has reduced in the past decade due to the rise of private brands. Some of the private competitors are Sleepy Owl, Rage Coffee, Blue Tokai, King's Coffee, and Billy Who Coffee. These companies are backed by private equity or venture capitalists and have raised significant funding in the past few years. They pose risk to the public FMCG companies as they reduce their market share. To conclude, we hope you learned something today and thank you for listening to us.